The financial markets party is long over. The talk of hot stocks and fabulous opportunities in cryptocurrencies and NFT has dropped to a whisper. Recession and bear market are the big buzzwords these days. Clearly, this isn't the happiest time for investors. If you've never put money on the market before, this may not seem like the most obvious time to start. However, there are advantages to investing in a bear market. With stocks falling in value and daily traders quitting, you're less likely to fall for fads because hardly any of them are profitable. Instead, you can focus on the essential goal of increasing your wealth in the long run. What is a bear market? A bear market is generally defined as a 20% drop from recent highs. The most common use of the term is to refer to the performance of the S&P 500, which is generally considered a benchmark indicator of the entire stock market. However, the term bear market can be used to refer to any stock index or single stock that has fallen 20% or more from recent highs. For example, we could say that the Nasdaq Composite plunged into a bear market during the dot-com bubble burst in 1999 and 2000. Or say that a particular company is making poor earnings and its stock falls by 30%. We could say that the stock price has fallen into bearish territory. The terms bear market and stock market correction are often used interchangeably, but refer to two different magnitudes of negative performance. A correction occurs when stocks fall 10% or more from their recent highs, and a correction can be updated to a bear market once the 20% threshold is reached. What to do in a bear market? Severe bear markets can wreak havoc on your finances. Economic downturns can lead to wage cuts, reductions, and late payments. Before delving into investing in a bear market, it's best to arm yourself for a bubbly economy first. Create a pillow and create an emergency fund that covers expenses for 6 months. This will save you in eventualities and prevent you from using your retirement savings. Bear markets are also a good time to reevaluate your risk appetite. Some investors wait to break out of the bear market before investing. When the market fully recovers, investors often realize they've missed the bus. The longer you wait, the more you will be behind. So make a staggered entry into the market, but make sure you have enough cash on hand. To make informed decisions, having a financial plan is essential. Without a plan, you are likely to make rash decisions during the market turmoil. Bear market examples. Bear markets are quite common. Since 1900, there have been 33, so they occur every 3.6 years on average. Just to name the three most recent noteworthy examples: 2000 to 2002 dot-com crash. The growing use of the internet in the late 1990s led to a massive speculative bubble in tech stocks. While all the major indices fell into bear market territory after the bubble burst, the Nasdaq was hit particularly hard. By the end of 2002, it had fallen about 75% from its previous highs. 2008 to 2009 financial crisis. Due to the wave of subprime mortgage lending and the subsequent packaging of these loans into investable securities, a financial crisis hit the world in 2008. Many banks went bankrupt, and massive bailouts were needed to prevent the collapse of the U.S. banking system. In 2009, the S&P 500 was down more than 50% from previous highs. 2020 COVID-19 crash. The 2020 bear market was triggered by the COVID-19 pandemic that hit the world and caused economic crisis in most developed countries, including the U.S., the fastest in history. Investing strategies to prepare for bear markets. Match your money to your goals. Create a plan that takes into account what you're saving for, whether it's short-term expenses or future financial goals like college tuition or retirement. Structure your portfolio to match these goals. Money that you will need in the short term or that you cannot afford to lose, a down payment on a home for example, is best invested in relatively stable assets, such as money market funds, certificates of deposit, or treasury bills. Targets needing funding within 3 to 5 years should be addressed with a mix of investment grade and CD bonds. For money you won't need for 5 years or more, consider assets with growth potential such as stocks, which are more volatile. Remember, downturns don't last. The Schwab Center for Financial Research has been analyzing the bullish and bearish markets of the S&P 500 index since the late 1960s and found that the average upsize has been active for around 6 years, generating an average cumulative return of over 200%. The average bear market lasted about 15 months, generating an average cumulative loss of 38.4%. The longest period for the bears was just over 2 years, followed by a nearly 5-year bull run. The shortest was the pandemic-fueled bear market in early 2020, which only lasted 33 days. How does this affect your bear market kit? Even if you are in the second year of a bear market, remember that it won't last. No bull market lasts forever, not even a bear. and historically, the bullish movement in the market has tended to outweigh the long-term bears. Know that you have the resources to weather a crisis. Some people panic in a bear market because they don't know if they have enough liquidity to manage short-term goals, says Mark Riepp, CEO of Schwab Center for Financial Research. Ideally, you won't have to face this question in a crisis because you need to know the answer. If you've retired, knowing that you have the next 12 months of living expenses in a bank account or money market fund and a few more years in bonds owed when you need the money can help you keep calm and alert, says Marco. You will react very differently to someone who goes blind and has never laid the groundwork. It's not just about your risk tolerance, but your ability to emotionally handle large swings and price losses, he adds. It's about your financial ability to manage risk. In other words, can you afford to take a loss? You may feel risk tolerant, but if you haven't structured your investments to handle a steep downturn, you may need to make painful lifestyle changes when the crisis hits. Hedge and speculate prudently with options. Only a small percentage of options traders make money, while the vast majority of retail investors who crave leveraged return options can lose so much money that economists can only assume they are doing it for gambling and entertainment. If you're not sure you're a small minority, you probably aren't. And if I did, I wouldn't be here to learn that some options trades can make money for the smart or lucky speculator in a bear market. You may already know that put options or put spreads, especially those bought after a bear market rally, can be used to hedge long positions or bought for a speculative trade. At least if you buy a put option, the acquisition cost is the value at risk. Selling a put option, especially in a bear market, can be much more expensive. As prices fall, there is a good chance that the put option will be exercised. And even if you end up buying a stock you want to own at an acceptable price this way, there's a good chance that further bear market declines will push it lower. Keep your portfolio diversified. Let's say there is depression. Is there a remedy to help your wallet recover? Being well diversified can help offset losses. In any bear market, some segments of the markets are likely to be hit much harder than others. It is extremely difficult to predict this in advance. So a precautionary measure you can take now is to diversify within the stock market as well as between asset classes. Consider the resources you have set aside for medium-term needs or goals. Being diversified means having a wide variety of investment-grade bonds, corporate, municipal, treasury, and possibly foreign. And they should have variable maturities from short to medium term, so you will always have bonds maturing and they will give you income or money to reinvest. Your long-term assets should be split between a wide range of domestic stocks, large and small, fast-growing and dividend-paying, as well as international stocks, real estate investment funds, and commodities, says Mark. This combination gives you exposure to asset classes that tend to move at different times and speeds, he says. Include cash in your kit. Cash is one of the lowest yielding asset classes, but don't let that stop you from seeing its long-term potential as a diversifier in your portfolio. Liquidity has a very low correlation with other asset classes, so it can offer protection from volatility. Another benefit? Cash reserves can come in handy in falling markets. With cash, you can buy when prices are attractive low without having to sell stocks at a loss, if they are also at a low point. So cash can give your portfolio some stability, low correlation, low volatility, and flexibility to buy new investments without selling old ones cheaply. Find a financial professional you can count on. Finally, your bear market kit could benefit from having a built-in buddy system, so to speak. That is, if you are unsure how to structure your portfolio correctly, or think you are tempted to do something reckless in a market downturn, you need to find a financial professional you trust to work with you. That person can guide you through a full portfolio review and help prepare you and your portfolio for times when the market gets tough. With that being said, it's time to end today's video. Press the like button and subscribe to our channel for more interesting stuff.